Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. And if you're rich yet still somehow broke, this video is for you, right? And there's a phrase that about how the rich get richer, and this is what we're going to do. We're going to make the rich richer today. Okay, so there are a good number of people out there because they email me from time to time who make good money and that they're still broke, right? And why is it that they're broke? Is because they don't know how to manage their money. You ever give anybody like $1 million, aka the lottery, and then 5 years later they're dead? It's because that money does not make their life better. You have to build the foundation to handle the money, right? You have to build that foundation. Most people don't have that. They just thought it was just going to all work out for them, right? And what we do in this country is when it comes to money, it's like we resent other people for trying to teach us, right? The way that I always like to phrase it is that, hey, don't try to teach me anything, man. I'm just gonna learn how to. I'm just gonna drive a car. But if you try to teach me how to drive it, that's stupid, man. And then what happens is that we crash the car, we screw up, and like, oh, maybe I should have learned how to drive, right? It's the same thing with money. It's the same thing with anything, real estate, anything, right? You know how many landlords I know who like just I told them like, hey, you know, let's learn together the landlord business, right? And they're like, I don't need that. And then 3 months later, and I know three people like this regretted being a landlord, and it's like, well, I don't regret it. I don't regret it, right? So even as we make more money, we have to know the skills how to handle that money, and a lot of people are against it, right? A lot of people don't even let the thought of the idea that they can make more money, right? You know how many people I talk to are like, "Well, you don't understand. I can't make more money because of X, Y, and Z." And I'm just like, you know, looking at my previous tax statements or social security statements where it's like, "Oh, you only made," and it's very embarrassing because I don't want to tell you, way less than $20,000 for many, many years because you were probably depressed and didn't want to do anything with your life, right? Yeah. So that's how the world is. But you know what? I want you to think this way, right? Even if you're not making that much money right now, just imagine that you're going to be rich one day. And a lot of it's the attitude, right? The fact that someone's going to give you 10, 20, 50, $100,000 check is just based on the attitude of whether you feel like you deserve it or not. And if you don't feel like you deserve it and you're constantly going to tell yourself, hey, I'm not going to make that money, well, it's going to come true. Like it definitely will come true. It's like the people who say, isn't housing going to crash? Well, one day it will, but there are people who are just getting rich off of making those videos and it still hasn't crashed yet. So, all right, well, enough of that. So, if for today's video, we're gonna imagine, or not even imagine, we are rich. We're making a lot of money, and we need to become richer. Okay, and how do we become richer, or is it more rich or richer? Richie rich? I don't know. Um, where are we gonna become richer by paying off our debt? Right. And a long time ago, I did this scenario, but I think it's worth visiting one more time where we got two lawyers, two lawyers in the household, right? And we make $290,000 gross as W-2 employees, okay? That's 16,000 a month after tax. That's pretty good. And you know what? I was looking at one of my bank statements and I was like, 16 do I make almost $300,000? That doesn't seem right. I probably just fudged the numbers and did something wrong. But my point is this. Okay, let's just imagine that we are making that good money. We're making that good money, okay? And but we kind of feel the pinch. Like if I made 16 grand and I only had 2 grand left over, I'd be like, "Ugh." Like, you know that I Love Lucy? She whenever she gets in trouble, she's like, "Ugh." I don't know if I'm doing it right, but I'd feel that way if I saw that. It's like, I make 16 grand a month. How do I only have 2 grand left over? Right? And the reason why we have 2 grand left over is because we got a lot of credit card debt. We got a lot of debt. Law school debt, auto loan, credit cards, a mortgage. Yet we were a little bit modest on the mortgage. Okay? A little bit modest, 300,000. I would prefer, a $200,000 mortgage, but probably the realtor convinced us, hey, we deserve it. And those 3 words have probably ruined more lives than you'll ever imagine, right? So, let's go ahead and do this velocity banking. So what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. Yes, a line of credit. And what's a line of credit? All it is a financial tool where you can borrow money, pay it back, and use it over and over again. So there's different types of lines of credit: personal, home equity, business, um, credit cards, right? Because you can use it over and over again. So anything that's revolving is a line of credit, right? That's all a line of credit is. And this is my home equity line of credit where I have over 280, no, not over. I have $280,000 in just one line of credit, right? You offer your home equity as collateral, blam, you could borrow up to 280,000. Go to the bank's website, click a button. I just click a button and then I'm good, right? That's how it works. So, home equity line of credit, okay? Currently, I have over $575,000 in lines of credit, 575,000. And how did I get it? It's because I know that you have to make money, right? Banks don't like to lend to people who don't make money. Banks don't lend money to people who need it, but they want to make sure that you're a non-risky quote investment, aka a loan or a credit card, and they only lend to you when you don't need the money, and then eventually when you mismanage it, they'll be like, "Whoa, whoa, 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 we can't give you another credit card, you need money." And you're like, "What the F?" And because most people don't know how the system works, they don't understand the trap, because what the bank wants you to do is to segregate your income, right? Get a bunch of debt. You need something else, just finance it, right? It's just a slow monthly payment. And if you have too many of those low monthly payments, then that's what makes you broke, right? Because you're just making minimum payments on everything. That's what we call the segregation of income effect. Paycheck comes in your checking account, gets split up the wazoo, and then you're making minimum payments on everything. And not only that, you got this little savings here. And because you feel like having savings is responsible, right? Having savings is responsible, then you're not going to apply your money to debt anymore. Okay. Now, this is what we're going to do. Same income, but we're going to put our big boy pants on. That's what happens whenever we have our savings goes to zero, right? That's when we have the big boy pants. And then we're going to copy the expenses, okay? And then we're going to have cash flow, right? So cash flow just means you're going to put all your money into the debt, and that's how much it's going to reduce by in the case of velocity banking, right? So if we go here, you see this is what we mean by zero savings, is that in the beginning of the statement, checking account, savings account, you should have zero. Or I'm not saying you should because I don't give financial advice, but I should have zero. And at the end, I should have zero. That's what we mean by zero savings, right? And so let me just go in here. And the easiest debt that we can move, right? First of all, we need a line of credit, which we're not going to get because banks don't lend money to people who need it. We always have to get it before we need it. And a lot of times when people do have lines of credit, personal home equity, they just treat it like another credit card, and it's just it's up to the max, right? And so right here, we'll just assume we have a $200,000 home equity line of credit, and just as a general rule, what credit cards or debts do we move? Well, we move the high interest rate credit cards and the short term loans into the line of credit. That's just a general rule, right? So let me go ahead and start off with the $167,000 in lines of credit, 167,000, right? And then simply by doing a balance transfer, right? We're just transferring the balance, right? But it's not like the credit card balance transfer where you can only transfer the money into other credit cards. We can use it to pay anything, but we're going to start with the credit cards. So this is 0, 0, 0, 0, 0, 0, 0, 0, 0. And guess what? Our cash flow is now 7 grand or a little bit over 7 grand. So this is how we're gonna do: paycheck, entire 16 grand into the line of credit, expenses out, and then we rinse and repeat over and over again. Rinse and repeat. Okay. So let's just go ahead and do this. Okay. Minus 7366.38. Okay. So all this is, right, we're just calculating the next month's balance, which is the previous month's balance, previous month's interest minus the cash flow. And then we got to calculate the interest based on that average AVG daily balance. Let's go ahead and get these, multiply it by the interest rate, and then we divide by 12 because it's calculated monthly, although it's quoted annually. It's kind of weird how that works, right? And then we just copy and paste and see how long does it take for us to get rid of the debt. How long? Do you see that? 25 months? That's pretty good. All right, so let's go ahead and record the milestone. So 25 months. 25 months for 167. Okay, cool. All right, so we got that covered. Okay. And now we have 1, 2, 3, 4, 5. Okay. 5 loans. Did I even set up the loan calculator? I probably didn't, but you could see me do it in real time if we go ahead and do this. Control C, Control V. And I know what some of you are thinking. You're like, you go too fast. And it's like, bro, it should be inspiration for you to practice this over and over again, right? Over and over again so that you don't you know, uh so you can do it as quickly as I can. That's all I'm saying, right? It's all good. All right, so now let's go ahead and set this up. So now this is 20,007. Auto loan is 5. Auto loan is 5. 2407. 160,000 at 6. 130,000 at 5.4. And then 300,000 at 3%. And then this is 10 student years, or loans are usually 10 years. All right. Boom, boom. Let's erase this. Boom, 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 boom. Okay, great. All right, so I think we set it up. And now let's go ahead and do this and type in, what was it, 25 months. 25, 25, 25, 25, 25. And we know, we talked about in the previous videos about the cash flow index, how if we have loans under 50, it's okay to pay those off. So let's go ahead and do that. And so 37 grand, we're going to move into the line of credit to free up this cash flow right here. So this is 37 grand, 00, right? And then we're going to move it into the line of credit. All right, let's go ahead and do this. Plus 37513.83. And then what's our new cash flow? About 8 grand, right? So let's go ahead and do this. So 8554.45. Okay. And then we see that in 30 months, it's all paid off. It's all paid off. See how easy that was? That was easy. Just 2 cars in, what was it? 30 months. 30 months. All right. So 167, 187, is it 217? I don't even know. I can't do math. That's why I have Excel. And the bank uses an Excel-like structure to do the math as well. All right, so 227K. And then now we got the law school loans. So let's go ahead at 30 months, figure out what the law school loans are doing. So this is 00, 30, 30, 30, right? So probably with the law school loans, I would just chunk them. And we see right here, okay, this one has a smaller balance, but this one has a higher interest rate. Which one has the lower cash flow index? Let's just do this, okay? Let's do the chunking method, meaning that we just kind of take out pieces of the loan at a time and use that to figure out the debt payoff. So give me one moment to open up the Velocity Banking Calculator. All right, we got the Velocity Banking Calculator up and running by Renatus. Just kind of quick plug for Renatus. If you're interested in not only learning about velocity banking, but stepping up your game in real estate investing and financial literacy, click the Google form link below. This is where I got the like first learned the velocity banking concept from. So just a quick plug there. And it's where I got the calculator from too. People are asking me like, can I get the calculator? I was like, are you going to pay? Nope. And then they just run away. Okay, no worries. Okay. 1.3 years. All right. So let's go ahead and do this. And then, all right. So let's do this. 1.3 years. How many months is that? So that's 30 divided by 12 plus, or maybe I do 1.3 times 12 plus 30. So it's, I'll say 46 months paid off, right? This now goes to 0. And then how much is that? That's 227, 7 plus 160, 387K, right? And we have to treat amortized loans a little bit differently from credit cards. Just because when you move it into a line of credit like these, the higher interest rates, obviously you want to move it into a line of credit that's a lower interest rate. But when you're dealing with like low interest rate like loans or lower interest rate, you got to be a little bit careful. That's what the velocity banking calculator kind of helps me confirm, because you got to be a little, yeah, you got to be a little bit careful with that. Now let's do the second one, right? So now law school loan 2 at 46 months. What's the 46? Whoa. All right. So now that one is at 88 grand. So what's the balance here? 130,000 is the original balance. 130,000. Not 1.3 million. Uh-oh. And then the current balance is actually 88,226.26. 88,226.26. What's the interest rate? 5.4. And then 1404.41. 1404.41. Okay. Is that right? Did I do it right? Okay, yeah, I think I did. All right, so now what I got to do is take out or sum up the expenses, right? It's everything except for the loan. Wait a minute, did I screw up? I might have screwed up when I did this. Uh-oh, SpaghettiOs. Remember that episode of The Simpsons when they did that? Hold on, let me just make sure I did this right. Okay. So I just want to make sure if these expenses are correct. And so if I did this correctly, it should sum up to this, right? Nope, I screwed up. I screwed up, so it might be even a faster payoff time. 5669.22. 5669.22. 1.1 years. Ooh, that's even better. That's a spicy meatball. So 30 plus 1.1 times 12 is 44 months. So just a couple more months. Yeah, 44 months. Yeah. And then this one, so let's go back and do the redo again. Redo. What's the shortcut for redo? Is it Control R? I don't even know. All right, whatever. I'll just retype it in again. I don't think it's working. All right, so now it's 130,000. Let's see. 130,000. What's the current balance? It's 88,226.66. 88,226.66, 5.4%. And then the payment is 1404.41, 1404.41. And then what's the current living expenses? It's just everything except for the loan you're trying to pay off. So this we're not trying to pay off. So it's 4264.81. 4264.81. 0.7 years. 0.7 years. Okay. So basically 0.7 44 plus, wait, 0.7 or 1.7? I can't believe it. 7 divided by 12. So 53 months. And I probably screwed the math up too, but it's all right. It's so fast that even if I screw up, I'll be pleasantly surprised when this happens in real life, right? And then now it's our mortgage, right? So let's go ahead and chunk that mortgage. So this is going to be 3,000 now. And then what's our mortgage? So it's originally 300,000 at 3%, 30 years. And what's the payment amount? It is 1264.81. So this is 1264.81. And then our current balance is, we're going to drum roll, 53 months. 53 months. Whoopsie, not 5. 270,863.64. 270,863.64. 1.8 years. Whoo, look at that. Look at these interest savings. It's pretty sweet. 1.8 years. Okay, so now where does sheet go? So 53 divided by 12 plus 1.8. So that's about 6.22 years debt free. And how much was that? That's about 800, almost 817K, right? 817K. What happened here? It just says or maybe I'll just leave it. That's like the new word for debt free. Okay. So, okay. All right. Yeah, I don't even know. All right. So let me just end with this. With $817,000 paid off and these all go to zero, now we got that ultimate cash flow, 13 grand. Now we can splooge, right? Hopefully we don't splooge again like this with all the $167,000 in credit cards. But hey, if we did, it wouldn't be no problem, right? Because we could get rid of that credit card debt really easily, because we don't have the other debts anymore, like the law school, auto loan, the mortgage. And so now, how should we end this? Well, now I guess, okay, we'll say mission accomplished. The rich are richer, right? That's the video for today's or that's the goal for today's video, right? The rich getting richer. Because I know some of you are looking at this income and like that would be so sweet, but a lot of broke professionals out there, a lot of broke lawyers, doctors, lots of them. Well, I won't say, I don't know if it's the majority of them, but there's a good number of them. Okay. All right. Well, this is Karina Lanta Mentorship. Yep. Have a great day. Have a happy, beautiful. Is today Wednesday? It's a Wednesday. Have a great day, and we will speak next time.